All right, so what we know is that Costco is trading today, Costco US equity, at about 123 a share. That's where they closed. So what we're going to do is, in this class, whenever we do a valuation of a company, we're going to perform two valuations, right? The first valuation is what we're going to call the as-is valuation. And the second valuation is what we're going to call the final valuation. The point of the as-is valuation is that we have a data point where Costco is trading at 123.31 today. So what we want to do is replicate a valuation in our cash flow model that's very close to the current stock price. And I'm going to say very close as in within $1, plus or minus. So we need to come in to a value of the company within $1 of 123.31. Right? That's called the as-is valuation. Now, if you think about it conceptually, in our model is a cash flow driven model that says if these assumptions come true, here's what the share price should be. Well, what we're going to do is we're going to work backwards. We know the result. We know the share price. We know the answer has to be 123.31. So what we want to do is we want to think about what assumptions have to be made to justify that price. Right? Very important. It's not whether we agree with those assumptions, right? It's just we have to figure out what kind of assumptions could be made on a cash flow basis to get us to a 123.31 stock price, right? That's what the as-is valuation is about. What we're then going to do is valuation number 2, which is what we'll call the final valuation. When we make the assumptions, it's not whether or not we agree with the assumptions, okay? It's whether or not for the as-is, those assumptions lead to that price. All right, so what reasonable assumptions lead to that price? Because we know what the price is. When we get to the final valuation, then we could say, you know what? I don't like the assumptions. I think the assumptions should be different. I then put in my assumptions, creates a new stock price. The difference between that new stock price and the as-is, buy, sell, hold. Okay, so generally if I'm within 10% of the current stock price, when I put in my assumptions for what I think should happen, then that's considered a hold. Because a hold is a trading range. Most investment banks use plus or minus 10% of the current stock prices for hold. So the idea is if I come up with a value of 130 and they're trading at 123, like that's not a compelling reason to go put a lot of money at risk to try and get that little of a return. All right, because just in a trading range, you could go up and down based on some random economic news in the very short run that could put it close to that trading range. So generally, above 10% is a buy, below 10% is a sell, plus or minus 10% is a hold. And that's what you guys are going to be doing in your group projects here in about 3 weeks from today with the companies that you're working on in the defense and aerospace industry. So in order to help us with the model that we're going to be building, we're going to take 3 additional screenshots from Bloomberg to do the as-is valuation, right? And I'm going to put them on video so that they're easier to see. But the first one is we're going to need the security description, or what's called the description screen in Bloomberg, short code DES. So we'd click on this, and the reason why we're going to use this screen is because down here on the left, it's going to tell us the current shares outstanding for Costco. So in order to figure out the share price, we're going to need to know how many shares they have outstanding. Well, here's where we can get the shares outstanding. It's on the description, short code DES. So what you can do in Bloomberg is if you go up here in the upper right-hand corner, in the software, there's an export button. If you click on export, save screen as file, and then basically you can save it to your laptop or a laptop to like a thumb drive or something, or email it to yourself from the desktop, or put it on Dropbox. But in this case, I'm going to use the ticker symbol, COST, just so I can identify it, and then dash, and I usually put in the screenshot name, DES. And it'll basically take a picture of that file. So if I go to my downloads folder, then there is a copy of that screenshot. Okay. Second screenshot that we're going to need in Bloomberg is we're going to have to discount the cash flows. So we're going to go to the weighted average cost of capital, WACC. and this will give us a real-time cost of capital. All right, and under the enterprise DCF model, we're going to use a constant cost of capital because we're going to assume the company works to a target capital structure. So here's the WACC. Equity is calculated using CAPM. Cost of debt is based on the yield to maturity of their debt today. So again, all of this is updated in real time. They do a weighted average just as you would have done in your previous finance class. So again, file, save as, save screen as file, Costco WACC. The third screen we're going to use, and you can see this off the main screen, is under the earnings estimates, and specifically the short code to get there is earnings estimate overview. So you can go to the earnings estimates and then to the overview screen below, or in Bloomberg you can type a short code. In this case, EEO stands for earnings estimate overview. Hit enter. These are the consensus estimates by the Wall Street analysts that are covering Costco. So by default, it gives you a quarterly view. If I click on the drop down for periodicity, I can switch this to an annualized view, and this is the annualized data for Costco. So here's the consensus data today. Going forward, you can see here for 5 years. But what you'll notice is this number is the number of analysts that are in the consensus estimates. And you'll notice that after the first 2 years, that the number of analysts that are forecasting Costco starts to drop dramatically because they don't want to put themselves out there too far. Because again, if they're wrong, they lose their jobs. So the first 2 years are usually the most heavily forecasted. After that, it gets more lightly forecasted. But here's the thing. For Costco, we have to come up with a forecast for financials. Rather than coming up with our own forecast, because this is the real world, it's important to understand that HDS is the holder screen in Bloomberg, that 85% of Costco is controlled by these 18 institutions. So our valuation should take into account these consensus numbers because it's really the kind of professional institutional view that is really determining the stock price, particularly for big companies. So the earnings estimates overview screen gives us some insight into that view. So we're going to use that to help us do our valuation. So in this case, what we care about is the EEO screen to help us do the first 2 years of our valuation rather than create it ourselves. So instead of creating 10 years worth of forecast, we're going to do the first 2 matching the EEO, and then we have to do 8 years worth of forecast. And the first 2 are probably the most important anyways. So we're going to start out by putting in the consensus estimates. So again, back to the earnings estimate overview screen. Make sure we do the annualized data. File, save screen as file, Costco-EEO. Those are the 3 screenshots that we need to do our as-is valuation, okay, for the companies that we work on. So I'm going to go back to the Costco file, and I'm going to start putting in this data. So first, I'm going to go to the assumption screen, and one of my assumptions was the weighted average cost of capital. So I'll make it a couple more decimal places just so I can see this. But right now, I want to put in the best estimate for the WACC, and right now, that's 8.4%. So I'm going to switch my WACC here to 8.4%. Next, shares outstanding. Right, I think we'd actually put in their current amount, but I just want to make sure I have the most current amount, 436.9 million, 436.9 million. Okay, so I have their shares outstanding. Okay. Next, if I go back to my income statement, which we had forecasted, the first forecast year is 2014. So what we want to do is we want to forecast 10 years, and then we want to figure out the continuing value period. Well, first I want to talk about the first 10 years. And I told you for the first 2 years, we want to match the consensus estimates. So in this case, we're going to use the consensus estimates for the first 2 years and put that into our model. Now here's the other thing we're going to do is we can't put them in this screen, so what we have to do is we have to put them in the ratio screen. Because remember, the forward ratios create the forward financial statements. So what we're really going to adjust is the ratios. Now, there are 20 ratios that we can change. And that's a lot of ratios to be forecasting. So here's how I'm going to simplify it. This is the 80-20 rule. So there's 3 ratios that matter more than anything else. And so instead of changing 20 ratios, we're going to focus on changing 3 ratios to do our valuations, because these are the ones that matter most. So most of the value, and we can see this on our DCF valuation, of Costco is in the operating value. Almost $40 billion of their 42 enterprise value is the operating value. The operating value of a firm is based on the free cash flow. So what matters most are the ratios that determine free cash flow. Free cash flow, which we can remind ourselves from the CFI screen, is gross cash flow minus gross investment. So what we care about are the ratios that determine gross cash flow and gross investment. I'm going to start out with gross investment. One of the simplifying assumptions we made when we did the balance sheet ratios last week is we said all of the balance sheet ratios are a percentage of revenue. All right, and I said it doesn't make a difference to do it that way versus the way the book originally recommended, which is tying it to its original driver. Here's the advantage of the process, which is as revenue grows, since everything is a percentage of revenue, the balance sheet grows with it. All right, so implicit in this assumption is constant productivity, so that the productivity of the firm stays the same. And for most big companies, we don't assume massive changes in productivity over time. So the idea is if the company gets bigger and the balance sheet is a percentage of revenue, then the balance sheet gets bigger. If the balance sheet gets bigger, current year balance sheet minus previous year balance sheet gives us what? What's the change in balance sheet give us relative to free cash flow? Change in working capital, change in PP called CapEx, change in goodwill, change in invested capital. It gives us gross investment. So basically, by letting the balance sheet grow with revenue, we're implicitly forecasting our gross investment, assuming constant productivity. Now, if we think that the productivity shouldn't be constant, you are welcome to change any one of these ratios. But in the real world, few of these balance sheet ratios ever get changed. So that's what we said. I'm eliminating needing to change the balance sheet as a starting point. So even though they're there, we probably don't need to start with those. So that forecast is gross investment. Now we need to forecast the other half of free cash flow, which is gross cash flow. Well, the key driver to gross cash flow, no plat. So what we really have to forecast is no plat. Well, let's go back to the ratios. What allows us to forecast no plat? One of the items, the tax rate. So the tax rate is something that we're going to care about forecasting. Right? In fact, I'm going to highlight this and I'm going to make it this kind of aqua. Oh, I'm going to make the letters that color. I'm going to highlight this just for your own benefit so you can see which one they are. Kind of this kind of aqua color. This is kind of off green. But here's the thing. This is one of the key numbers that we have to forecast, which is what is a realistic tax rate going forward for Costco, because that's going to impact their no plat, right? So what is the tax rate? By the way, tax rate goes up. So 32%, it's 40%. Look what happens to the forecasted share price. Drops dramatically. Tax rate goes down to 25%. Stock price goes up. So tax rate is also something that will impact cash flow, will impact free cash flow, will impact valuation. So how do I decide what a reasonable tax rate is on a go-forward basis, particularly if I don't know too much about Costco? Well, here's the advantage of the historical ratios. I have 6 years of historical tax rates. 35.8, 36.6, 35.6, 35.3, 36.1, 32.4. So here's what I'm going to do. I'm going to take an average tax rate for the last 6 years, which works out to be 35.3%. And I'm going to say that that seems to me a reasonable tax rate for Costco to be paying on a go-forward basis. Now, obviously, if we could do some more diligence and we can get more closer to what the company thinks the tax rate should be go forward, that's the number we'd want. But I don't think it's going to be too far away from 35%. because one, that is the corporate income tax rate, and two, they don't seem to be paying a lot less than that. So I think that that's a reasonable tax rate for Costco going forward. So that was one of our assumptions. Clear on that one? Questions about that? All right, so I forecast the tax rate, which means now I got to forecast operating income. Well, I can't forecast operating income directly. How do I forecast operating income? I have to forecast revenue, and then I have to forecast the costs that go into operating income. Well, let's start out with the revenue forecast. How do I know what Costco's revenues are going to be in the next 2 years? Well, that's where I can get some insight into the earnings estimates. So on the EEO screenshot we took, there's the estimate for 2014 expected revenue and 2015 expected revenue. So what I'm going to do is I want to put those two estimates in my model. So here's where I'm going to put them. On my assumption screen, make this a little bit bigger. I'm going to call this forward sales 1, forward sales 2. Right? The convention for sales 1 is the upcoming year. The convention for sales 2 is 2 years forward. So for Costco, 2014 is the first upcoming year, sales 1. 2015 is the second forward year, sales 2. Okay, so I'm going to write it in here, 114, 145. That's the expected revenue for Costco in forward year 1, and 123,594. That's the expected revenue for Costco in forward year 2. I'm going to make these yellow cells. Put some dollar signs out there. And that is the expectation for revenue for the next 2 years. Questions about those two numbers? All right, so go back to my ratios tab. So what I need is the percentage change in revenue in 2014. That gets me to 114,145 on my income tab. That's the number I want that to be. So I have two choices to do that. Choice 1 is I can continually change that number until I get to that number. Or choice 2 is I could solve for it. So I know that the formula for percentage change, go back here, to solve for that equals the current year revenue, which is my sales 1, minus my previous year's revenue, which was 2013 actual sales or revenue, divided by my previous year revenue. A little over 8.5%. So that gets me to 114,145, which matches the 114,145. Right? So I basically just solve for it. Current year minus previous year, that result divided by previous year is percentage change. Right? So basically around 8.5% gets me to the revenue target. Notice that my share price is now higher. I'm now at 94.91. I'm closer to the current share price as well. Remember, see what we just did? We'll do this for year 2. Year 2, 2015, equals, left paren, from my assumptions tab, forward sales 2 minus forward sales 1, right paren, divided by forward sales 1. 8.3%. That gets me to 123,594, which matches the 123,594. So all I've done is I've just put in the growth rates that match the consensus for the next 2 years, approximately 8.5% and 8.3%. So now I have the revenue. Last point I need is the expenses that match the operating profit to give me the NOPLAT, because again, I'm forecasting gross cash flow. So I know, so I'll make this one kind of that greenish color. I know that my operating profit in forward year 1 and my operating profit in forward year 2 have already been forecasted. 3403 and 3751. So 3.4 billion, 3.75 billion. Those are the consensus estimates for the next 2 years for operating profit. Now, I'm using operating profit, even in the model, called it operating income, basically the same number, right? But that's what we're forecasting, and that's what the consensus number basically is. The same thing. It's terminology used here on the street. All right, so back to my ratios. I can't forecast operating income directly. In fact, I'm going to do this just so you don't get confused. I'm going to change this to operating income. Just so it matches what's in the model. So you're not confused about the terminology. Right? So that's your operating income 1, operating income 2. All right? So I need my operating income to be 3.4 billion in my income tab. That's what this number needs to be. But again, I can't directly forecast that number. What I have to do is I have to forecast the ratios that get me to that number. Right? So here's how we're going to do this. On the Assumptions tab, my first forward year equals, I'll get out the Ratios tab, is 2014. And my second forward year is 2015. And just so I can see how this will affect my share price, I'll put in my forecasted stock price right here, which matches the one on the Ratios tab. In fact, I'll make that consistent, forecasted price per share. Just so as I change things on the Assumptions tab, I can also see what the impact is on the stock price. Right? But here's the point. I have a consensus operating profit percent, which we had called operating income as a percentage of sales. So I'll call that operating income percent. But I know what the analysts are forecasting for operating income because it's right here on this page. In fact, in 2014, it's the 3403 divided by the 114,145. So the consensus operating margin in 2014 and 2015 is right here on the data that I just put in. 2.98% operating income as a percentage of revenue in 2014. 2015, it'll be 3.03%. That's what the current analyst operating margin is based on the consensus numbers from the earnings estimate screen. Everybody see those numbers, where they're coming from? So what I really need is I need for this number, instead of 2.9, I need for this number to be 2.98. So in my model, operating income percent, I have these two numbers. I have 2.9 and 2.9. I can make these percentages. So what I have to do is my model's 2.9, my consensus is 2.98. What can I do? How do I get those two to match on the ratio screen? What would you recommend doing? Changing what? Well, we could either change cost of revenue, or we could change operating expenses, or we can change depreciation and amortization. All three of those would change my operating profit. Now, in the real world, companies want to see the granular forecast of those three. The reality is the model doesn't care because the model is going to care about the operating income. It doesn't care whether it was cost of goods sold or it doesn't care whether it was operating expense. It just cares about the result. So we made a choice to not forecast the result. We chose to forecast the components. So here's what we're going to do. We're not going to change depreciation and amortization as the primary driver, and the reason why is because that's a non-cash item. So changing depreciation won't have the impact that we want because it's changing a non-cash item. So I want to change cash flow, which means primarily I change cost of revenue or operating expenses. To simplify things, I'm going to suggest that we use cost of revenue as the proxy for changing operating income. Just rather than changing two numbers, we're going to change one because the model doesn't really care, just to make our lives a little bit easier. So here's what I need to do. I need to reduce my cost of revenue by I have the operating income that I need minus the operating income in the model. So I need to reduce my cost of revenue by 0.08%. So if I go in here to ratios and I go to cost of revenue minus 0.0008. So now they have matched. And by doing so, the 3403 consensus forecast matches, I'm at 3405, but I'm going to call that close enough for rounding, the 3405 that's now in my model. Questions about what we just did? Yep.
Would you mind showing the cell, I guess, H4?
In the ratios tab?
Yeah.
H3?
Yeah.
All I did is I took whatever the cost of revenue was and I just subtracted the 0.08%, so minus 0.0008. Just manually put it in there.
Yeah.
Unfortunately, I can't solve for it because if I try and solve for it, I'll get a circular reference.
Right.
So I don't know how to get around this very easily. So that's why this is the manual step. Otherwise, you get a circular reference. So I just basically manually put that in. That's why I'm doing this extra step. All right, I'm going to do the same thing in 2015. 2015, I have to reduce it by an additional 0.0005. So ratios minus 0.0005. I'm now matching my operating margin in the model. By the way, I'm now up to an almost $100 share price. And I have essentially matched the operating income, got a tax rate, got my note plat, essentially got the first 2 years worth of free cash flow forecasted using the consensus data. Questions about what we just did? This, by the way, is a made-up term that we will use for this class, and we're going to call this the baseline. So this is the baseline valuation file for Costco. If you go to any other class or any other person, you use the word baseline, they won't know what you're talking about. But what we're going to refer to it as, we've taken our model, we've put in all of the data for the company historically, we've put in the key items like cost capital, shares outstanding, we've put in the consensus estimates for the first 2 years, and now we're ready to go from the science of valuation to the art of valuation. Because the art of valuation says that Costco's at 123 a share, and I have to then change assumptions, art, to basically get closer to 123 a share. Questions about any of that? Because that's our next step. That's going to be the as is. The as is says, how do I get to about 123 a share now? How do I get that extra $20 a share price? What has to change about Costco? Well, this is where, again, we'll use real-world data. So I'm going to go to the portal, smithapps.rhsmith.umd.edu, type in my username and password. And if I could just ask you to hold on for a second, because at the portal has more than like 3 people. It's like the healthcare.gov website. It just dies. So go to the finance tab. Just let me get there, and then you can follow along in a second. On the finance tab is something called IBIS World. Strongly recommend you guys take advantage of this as you're doing your valuations. So it'll launch a portal app. Now that it's launched, okay, you guys can follow along. But what IBIS does is they write industry research reports. And what you can do is you can either search by industry or type in a company name. In this case, I'll type in Costco and do a search. C-O-S-T-C-O. And this will tell me all of the research reports that Costco is in. Pick the one that seems most relevant. In this case, warehouse clubs and supercenters. Click on this, and this will give you a nice, you can download this as a PDF, a nice industry report that basically does a lot of the EIC analysis for you. They've done a 5 forces analysis, and they've done some other information. Because we're dealing with real-world valuations and using real data, it's perfectly acceptable to use some of this data to help you answer these questions. Just remember, don't plagiarize. Okay, so just as you used this for the other one, you could use this here. But here's the nice thing about IBIS. Over in the far right, quick part of the report, key statistics. In the key statistics, here is a forecasted growth rate for the supercenter, discount supercenter industry going forward. So I don't have the forward year forecast for Costco, but at least I know what's happening to the industry. And here's what I know. The industry, which had been growing at 8.9%, 8.6%, 6.2%, 6%, 6%, 0.2 in the recession, 2.93, 4.2, and 5.5 historically, including this year, is going to grow at 2.6, 2.2, 2.1, 2.0, and 2.1. So let's go back to Costco's revenue growth rate. They're growing at 8% the next 2 years. The industry that they're in is expected to grow at 2% for the next 5 years. So what is that telling us? How do they grow at 8 if their industry is growing at 2? They got to be taking market share. This is demonstrating some competitive advantage. The question is, what's going to happen to their growth rate for the next decade? If their industry is growing at 2, are they going to grow at 15? No. Is that likely? But here's the interesting thing. Their share price is 123. And if I lower their growth rate, what's going to happen to their forecasted share price? So what must the market be thinking about their current share price?
Growth rate.
It's not growth rate. The market, in order to give them a higher share price, says that the growth rate's probably not going to be higher than 8%. It's most likely to be lower because they're in a retail industry that's slowing down. So it's not growth that's causing them to get the extra $20 worth of share price. What must it be?
Cost.
Better margins, lower cost. So Costco is actually going to be a cost story. It's going to be about what type of margin expansion they have to achieve to justify the current share price, because implicit in their current share price is margin expansion. I can say that with almost certainty. Right? Because I don't think the institutional investors are looking at a retail market growing at 2% and saying they're going to keep growing at 8 for the next decade and then forever. So, as a matter of fact, if you think about it, they're growing at 8 when the market is growing 3 to 5 right now. If the market's going to grow 2, they probably have to expect lower growth rates. Now, if you look at Costco historically, 9, 14, 11, but in the recessionary year 6, and then negative 1.5, or at least a slow bump 2013, recessionary year negative 1.5. So the point about Costco is they're not immune to economic sensitivity. They're not immune to changes. And we probably realize that in the E section of our EIC analysis. So I probably want to forecast some sort of cyclicality in their business as well. But if I just want to keep it simple for tonight, what I want to do here is come into my ratios and at least probably after the first 2 years, start tampering down my growth, or tapering. The Fed word, they don't use tamper, use taper. Taper my growth. 6%, notice I'm at 87 a share. And then maybe a few years later, 5%. And then maybe 4% in the out years. And then, by the way, CVG 3% into perpetuity, eventually growing with the economy long term. So notice that my share price is now down in the low 80s. And I have to get it up to 123. It's almost $40 away. So that's the margin. So here's what I'm going to do. I'm not going to change the margin in the first 2 years. I'm going to go to year 3, change my cost of goods sold. What if instead of 86.2, and I could see that they were at 86.2 here historically, and the changes didn't seem all that dramatic. What if instead of 86.4, they went to 86.1? And what instead, a couple years later, instead of 86.1, they went to 85.8? And what if a couple years later, they went to 85.5? And then they went to, I don't know, 85.2? 85.1? And by the continuing value period, they went to 85. Well, now I'm at 123.08 a share, which is pretty close to the 123.31 stock price they're trading at today. Now, I don't know if these are the exact right numbers, that, somewhere around 4 or 5% growth. And here's the key, somewhere around a pre-tax operating income margin from 2.9 has to go to about 4.4, or after tax from about 2 to 2.9. They need about a little less than 1% increase in their after-tax margins to justify that extra $40 a share price, which also tells me that Costco is going to be incredibly margin sensitive. I mean, their stock price is going to be all about the margin. It's not about the growth rate. It's about the margins. Because 1 percentage point of after-tax margin is almost $40 worth of their share price. So therefore, it's going to have huge impacts in changes in margin. That's why when a company releases their quarterly earnings, you see such volatility in their stock price. Because it's not just the margins this year, it's when I forecast those margins on a go-forward basis, it really affects those forward cash flows. So I'm going to save this, and I'm going to call this my as-is valuation. Now, what is important when we do the as-is valuation is we have to justify our assumptions. Why did I change the growth rate to why I did? So it's not the assumptions that matter. It's what was behind the thinking that led me to change my assumptions. That's what you're going to have to do in your group projects. That's what you're going to have to do in your group paper. Is you got to not just tell me this is the price, but what assumptions did you change to get the price? Why did you change those assumptions? And again, it should be based on facts, or at least data. So in my case, part of my data was I looked at the IBIS World Report. And in the IBIS World Report, what was it? I looked at the industry growth rate, and I basically made an EIC assumption. I basically said that Costco's industry is getting tougher, the growth rates are slowing, but Costco will maintain its competitive advantage and continue growing faster than the industry. I just don't think they're going to grow at 8%. I think they might go double the industry. That's why I got 4 to 5% versus a 2% industry growth rate. So again, I'm giving them credit for growing faster with competitive advantage. I just don't think they're going to grow triple the industry. All right, I think it's going to be a tougher market on a go-forward basis. Second, I then talked about margin expansion. So I do think that their competitive advantage gives them some opportunity for margin expansion. Their prices are very low. They're very reasonable. You know, I'm personally shop at Costco a lot. And I know that if I walk into Costco, I get a good value. As a matter of fact, that's probably their biggest their criticism by Wall Street, is that the criticism on Costco is that they don't charge enough, that their deals are too good, and that their membership fees are too low, and they could probably charge even more in membership fees. So the point is, do they have room to get 1% reasonably? I don't think that's out of bounds to get an extra 1% margin to justify their 120-something stock price. So I don't see this as being an unreasonable stock price. Now remember, what I'm doing here with the assumptions is this isn't whether or not I think these assumptions are true. I have to explain the $123 stock price. Like, what range of assumptions could have been made to get that stock price? Now, I could have gotten that stock price by slightly higher growth rate and slightly lower margins. I could have gotten that stock price through slightly lower margins and slightly higher growth rate. But I think it's going to be somewhere in this bound of these two that quickly justifies that stock price, as is valuation. Questions? Comments? Now, to help us with the as is in our model, so I'll highlight here with this kind of greenish color the third thing that we were changing. We have a couple of other things that can help us as we do our as is valuation. First is something called the ROIC drivers. This is the ROIC tree. Okay? And the ROIC tree, something that was already put in the model. As we think about the future, we have to understand the past. And so part of understanding the future free cash flows, because again, ROIC drives free cash flows, is we have to understand what happened to the historical ROIC of the company. Well, for any company, there are three factors, always three factors, that explain their ROIC. And they're listed here on the tree. So, EOY stands for end of year ROIC, as opposed to BOI, which stands for beginning of year ROIC. So, as part of the analysis we're going to want to do with the tree, we're going to want to start 5 years ago, 2009 ROIC for Costco, and then we're going to want to look at the changes in ROIC over a 5-year period of time. So 5 years ago, their ROIC was 11.6%. Last year, it was 16.4%. Their ROIC improved. Why? Specifically, it went up by 42% over a 5-year period of time on an after-tax basis. One of the factors affecting it is the tax rate. So their tax rate 5 years ago was 36.6%. Their tax rate last year was 32.4%. Did that help or hurt their ROIC? Sorry? It helped. Their tax rate went down by 11% over a 5-year period of time. So that is one of the reasons that affected their ROIC. Is that the primary reason that their after-tax ROIC went up by 42%? Was it all explained by the tax rate? No. And the way we can see that is we take out tax rate, look at their pre-tax ROIC. It went from 18% to 24%, a 33% pre-tax improvement. So really the primary reason was the operational performance. Drivers 2 and 3. What drives pre-tax ROIC? Margin, cycle time. This is the operating margin as a percentage of sales. This is cycle time, just not multiplying by 365. So let's focus first on operating margin. Operating margin in 2009, 2.5 cents per dollar of revenue. Operating margin in 2013, 2.9 cents per dollar of revenue. Is that better or worse for their ROIC?
Better.
Better. They're more profitable. 16% more profitable. Cycle time. Well, this is invested capital divided by sales, just not multiplying by the 365. Here's how to interpret this. To generate $1 of sales, they had to spend 13.8 cents in 2009. To generate the same dollar of sales, they had to spend 11.9 cents in 2013. Is that better or worse? Better. They're more productive. So Costco actually did better margins. They were more efficient. Matter of fact, they had a 13% decline in their capital to sales ratio, which basically meant they had essentially an improvement in productivity, an improvement in margin, and a lowering of tax rate. The biggest impact, because these three things are multiplied together to get an after-tax ROIC, was probably the decline in the margins. But not that much more than the other three. All three benefited them. That's the first level of analysis that you need to do. Explain the three, how they led to the after-tax ROIC. Second level of analysis. Scroll to the right. What caused the operating margin to go up? Well, there we go to the income statement. Three items on the income statement led to operating margin, which is operating profit divided by sales. It's our gross margin or gross profit minus our SG&As minus our depreciation. So this minus this equals that operating margin. What happened to their gross margin? It went from 13.7 to 13.5. Did that help or hurt their operating margin? Actually hurt it. So the operating margin did not go up because of gross margin, which is the difference between the price and the cost of goods sold on their merchandise. They're not getting better markup on their merchandise, they're actually getting worse. So SG&A went from 10.2 to 9.7. Did that help or hurt? Helped. Depreciation went from 0.01 to 0.009. Now I know it was a big 11% decline, but it was virtually unchanged of a tiny number. So for them, what was the primary reason the operating margin went up? It was the lowering of their SG&A expenses. They cut costs faster as a percentage of sales than their price relative to cost dropped. So they got tougher margins, but they got more cost out of their system, and that allowed them to get more operating margins. So everybody see how we can make those conclusions? Okay. Productivity. Operating working capital plus PP&E over sales plus intangibles, which is acquisitions divided by sales of IP and goodwill, equals invested capital over sales. These are the three major components. We know productivity improved. The first, operating working capital, negative 1.6 cents to negative 1.3 cents. Is that better or worse? It's actually a little bit worse because they had negative 1.6 cents of working capital. Now they only have negative 1.3. So they're actually using slightly more working capital. Even though it's negative, it's a little less negative. So that's actually a little bit worse. PP&E and sales went from 15.3 to 13.2. Better or worse? Much better. Intangibles, 0.001 to 0.001 unchanged. Again, I know it says negative 39%, but that's due to rounding, and a tiny number versus a tiny number isn't really going to make much of a difference. So really, it was the improvement in facility utilization, PP&E to sales, drove their productivity. So if I wanted to tie it all together, Costco improved their ROIC by 42% to 16.4% because they got a lower tax rate, they lowered their SG&A expenses dramatically as a percentage of sales, and they improve their facility utilization and PP&E over sales as the primary drivers of their improvement in ROIC. That is the analysis that we have to do. And by the way, there's an identical question to this on your midterm. So since you're going to get a question like this on the midterm, questions about this analysis. Very important when you go through it, be specific. Refer to specific numbers. So you can't just say the margin went down. Give me the margin went from X to Y. Right? So you got to be referencing the actual numbers that you're going through in the tree as you're walking through. Yes?
Would you please discuss again the operating working capital of sales?
Sure. So working capital, remember operating working capital is the operating current assets minus the operating current liabilities. For operating working capital to be negative, you have more current liabilities than current assets. For it to be less negative, you have less liabilities than you did before. And if you have less liabilities, that means you use cash to pay them off. So by having less negative working capital, they actually invested in their working capital. So even though they have negative working capital, they have less negative working capital, and the change over the 5 years meant more cash was tied up in working capital. So that didn't help their productivity, it actually hurt their productivity slightly. Now the fact that they have negative working capital is still a benefit to them, but it's slightly less negative, which means they did do a net investment in working capital. All right? And by the way, there's a third level of analysis I'm not requiring you to do. Just interesting data to have. 3 primary but not sole sources of working capital. This is often called the cash part of the working capital cycle. Are inventory, receivables, and payables. Right? And you can see for Costco, they went from 32 to 31.7 of inventory, so virtually unchanged. 4.3 to 4.2 of DSO, and they went from 32.3 to 31.6 of payables. This is where they use cash. They're paying the equivalent of about 0.7 days faster, their vendors. And it doesn't sound like an amount that's that substantial, but when you're a $100 billion company, that's tying up extra cash. So that slight improvement, 0.7 days, is probably the primary reason why their working capital is worsening. Because that's the point. I have less liabilities to offset my assets. And so therefore, I'm tying up more cash. That's what I'm seeing with Costco. Not saying that's a really horrible trend, because for them, they got substantially more benefit out of their Costco stores. So their Costco stores are getting even more efficient. And my personal anecdote is everywhere I go to Costco, like their stores are completely mobbed. And so I think they're getting even more members going to every one of their stores buying even more stuff. And so that's the point. They're getting more sales out of every store. And it's showing up in the PP&E to sales ratio. Right? So they're just getting better productivity out of their warehouse clubs. And that's really one of the primary reasons their ROIC is going up, despite the fact that they have lowering margins. In fact, they're probably related. In the economic tough environments, people want a deal. You go to Costco, you know you're going to get a deal. You go there more. They put in higher value or higher valued merchandise, because the difference between Costco and Sam's Club is night and day. Sam's Club sells junk. Right? My apologies to Walmart. Costco actually sells some really nice stuff. And as a result, they're selling it at very low cost. That's what attracts people to Costco. In fact, I think that's why Costco accepts the American Express card. Because American Express card pays much higher fees on American Express transaction than Visa MasterCard. Why do you think Costco accepts higher fees on the transactions? Because if they're all about cost, they should be taking MasterCard. But they don't take MasterCard. They take American Express. Why do they take American Express? They don't. Visa MasterCard pays in 2 days. American Express pays in 4. Small business owner, I hate American Express. For payment terms. It's because American Express is a more affluent cardholder. And the more affluent cardholders pay or buy more stuff every month. So what Costco's trading off with the American Express card, just simple, is the fact that they get people that are going to come in and spend more. And that's basically why people take American Express, is they pay more fees, but you know you're going to get a more affluent cardholder who's willing to spend more money. And in today's world, more affluent doesn't mean they buy more expensive stuff. They look for deals. And Costco is the deal store. So I can get nice stuff cheaper. I want to spend, what is the ridiculous Dyson vacuum cleaner cost? What's the, like $400 or $500 for a vacuum cleaner? So you want a $400 or $500 vacuum cleaner? Get it at Costco, right? They sell that. You can't buy that at Sam's Club, I don't think. You know, you want the, what else? Grocery stores. One of the things that Costco is known for, if you like meat, is they sell prime, grade A prime meat at relatively low cost. So again, they attract people to come in and buy some very premium things. You know, you're getting a relatively good deal, and they sell it in volume. So that's been their model. It's been successful for them. And you see it in their margins. But that's the point. That's the knock. The knock is you have affluent shoppers thinking that they're already getting a tremendous deal. Raise your price 1%. Give me another $30 to $40 in stock price. That's been what the institutions have said to Costco. And Costco's like, no, what we're going to do is we're going to keep the margins low and keep growing our business at a faster rate. So they accept lower margins for higher growth. It'll be interesting to see what happens as their growth slows, as whether or not they stick to that lower margin commitment and whether or not they don't raise their price slightly, getting a little bit worse margins for us, but still better margins you can probably get most other places. So that's the conundrum they have in the future, and that's going to be key to their valuation. And so, by the way, when we think about the final valuation of Costco, that's the point. If they get their margins 1% higher in the future, what does that do to their share price? Say a couple years later, instead of 85.8, it goes to, I don't know, 85.3, and then it goes to just 85 and 87.8, 87.5. Give me an extra 1 point of margin. Sorry, I'm going in the wrong direction. Long day here. Undo, undo, undo. Redo. All right, so back to this. I want to go to lower margins. So I want my 85.3. Is that right? Start with this one. 85. 85. Just carry that across. So 85 is a $130 share price. 84 is 131. All right. I know I'm missing something. What am I missing?
They didn't copy into like 2017.
Yeah, they're not inheriting from the previous year, so that's just one of those back.
I'm sorry?
So you need K3 to equal J3.
Oh,
And then copy that one.
yeah, thank you. Because I know it's been a... Let's go here. There we go. Now I missed something. $160 share price. It's $30 a share, which is what we expected. Because we said before about a $1 stock price or 1% margin is about $30 to $40 a stock price. So what I've just done there is I've given you a buy on Costco. So if I really think that Costco can get and eke out an extra 1% margin and with relatively sluggish growth can actually get that extra margin that they have been avoiding and charge a little bit more to the customers, then now's a great time to buy Costco, and there's a lot more upside in their stock price than it is today. So I set my target stock price at 160, and I say go buy it. Buy it today. Because you can get something worth 160 that's worth 123 today. All right? Alternatively, undo. Alternatively, what if Costco starts growing at the industry growth rate closer to 3%? So instead of 6% growth, they're faced with 3% growth or even 4% growth that eventually tapers down to 3%. So they end up growing at the rate of the supercenter industry. Well, now Costco doesn't really look nearly as attractive. All right, they're at 114 a share. And if Costco's margins worsen a little bit, because in some of these years they were at 86.7, they weren't at 86.1. And so if they go back to 86.7 and their growth slows, yikes. I do not want to own Costco. Get out. Sell. Right? And I'm telling you, if you go to Bloomberg and you look at the analyst recommendations, ANR, you will see that there's a person out there that says get out. That's a professional. And you will see some people who say buy, and you'll see some people who say, fairly valued. There is no strict consensus on the future, right? And that's what I'm saying is that you can come up with different scenarios which gives you different future results for a company. And that's part of what we're going to have to get used to doing this semester, is you have to establish what is called a point of view, right? A very strong point of view of what you think is going to happen in the world, and your assumptions for the company will support that point of view. So I have to have a point of view on the industry. I have to have a point of view on the competitive advantage. I have to have a point of view on what the company is actually able to accomplish financially, and my assumptions will reflect that, and that is my point of view on the buy, sell, hold. And so I can come up with a buy recommendation, I can come up with a sell recommendation, I can come up with a hold recommendation. And then it's a question of which one do I think is most likely, right? And that's where I then put in my answer. But, here's UBS, he's a hold. And here is Stifel Nicholas, he's a buy. And here is Piper Jaffray, they're a buy. So again, you can get different people with different points of view. And what you're going to have to do for your group projects is come up with one. So given everything I've told you, which one do you think is most likely for Costco? What's your view? Are you in the buy, hold, or sell?
Buy. Buy.
Why?
Because I think it's more likely that they'll have less growth in revenues and they're able to effectively run their business and increase margins.
Okay. Does anybody have a different one? Hold or sell? Who thinks hold or sell? Yep.
Also hold, I think they'll try and keep their margins where they're at to try and drive revenue growth.
And at this level of margin, they're probably not going to see that much of a change in share price because the cash flows are pretty consistent. Okay. Is there anybody to sell? Nobody agrees with this random person over here who's saying sell? That's just an outlier. All right. But even the difference between buy and hold, I mean, that's the point. If I don't own Costco and I'm saying hold, why would I want to buy Costco? So essentially, to some degree, a hold is a don't buy, right? Because it's not really worth putting in a lot of capital to not really see the stock price appreciate all that much. I mean, don't get me wrong, you get some appreciation with a hold because theoretically you go by your cost of capital, right? So you get cost of capital levels of returns, but if I'm trying to beat the market, I want to do better than my cost of capital, and so that's the point. I need to buy for that. Yeah.
What are the difference in the recommendation? Outperform, buy, strong buy?
They just have their own words for buy, sell, hold. So for example, an outperform is another way of saying buy. Strong buy is just saying bye-bye. Kind of like the Backstreet Boys, bye, 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 bye. But basically, yeah, I know it's a terrible reference. But basically, if you think about it, these guys are actually using the equivalent of a 5-point scale. So a buy is almost like a 4, and a strong buy is like a 5 on a 5-point scale. So buy, sell, hold gets a little bit more broken down because the data services actually ask you for a 5-point scale when they score you, and they try and fit it into a 5-point scale. So that's why you'll start to see overweight is another way of saying buy, underweight is another way of saying sell, because you want to underweight to the percentage of the portfolio value. So if you have an overweight stock, you then have more of the stock than you normally would, so therefore you're actually saying buy the stock. Or accumulate would be another example.
Does Bloomberg give you access to the analyst's logic behind the numbers?
It could if you have access. So you have to either get access from the analyst firm, or I think you can probably pay for some additional access, which we don't in our student accounts.
Does this factor in dividends?
Mm-hmm. Yeah.
Does our student Thompson allow us access to that?
Yeah. So we also have on the portal, there's a product called Thompson One. And I don't use Thompson. I used to use Thompson One in this class, and I stopped for two reasons. One, it's on the portal, and the portal's unreliable. But the major reason I stopped was because the data that comes from Thompson One sucks. And it's a real problem when you do valuation. And I'm telling you, I personally looked bad because I would take data from Thompson One, I'd bring it, and then I'd talk to like a CFO. He'd look at my model and he's like, that's not the numbers that are in our 10K. And it doesn't take many of those to basically never want to use Thompson One again as a product. But that's the problem with Thompson One, is the data does not match the 10Ks of the companies. And product not usable as a result. That's why we use Bloomberg. Because if nothing else with Bloomberg, if I go to Bloomberg and I look at the financial analysis on Bloomberg and I click on the historical revenue for Costco, then what I can do, is it here or here? I think it's right here, is I can actually click on it and it'll show me where in the 10K they got it. And that little point right there is all the difference in the world between the data services. So CapIQ, Bloomberg, they take the time to make sure the data fits to what the company reports. Thomson, I think they just have a random number generator in there. I don't know. I can't explain why it doesn't match, but I've just been burned enough times that I do not rely on its data. But it's free on the portal, so obviously feel free to use it. Just be careful with the data. Yeah.
Is there any good way, while we're on the Bloomberg terminal thing, to grab the data we're going to want for the analysis instead of, or do we have to kind of go to each of the screens? Or,
Yeah. I mean, you can set up macros. They'll probably take longer than just going to each of the screens. In fact, one of my undergrads is interviewing in Bloomberg right now, and he said one of the constant complaints Bloomberg gets is that they break the macros on people. And they're like, my button doesn't work, and they'll call the help desk because, as they change their screens, it goes a certain way through the product. Because Bloomberg's been around for since the 80s. And that's why you use these short codes, because they used to actually not have any mouse support, and you'd actually have to type in all the letters to move around the service. So it's there. Again, there's probably ways to do it. But the other thing I was going to mention, there is one advantage to Thompson One, assuming it opens. See if I can get it to open. One advantage to Thompson One, and we'll use Costco, is it's like Bloomberg. You type in the code, search for it. I think they must have heard me and locked me out. But one of the things you can do is you can actually go to Thompson One and get the analyst reports. So that's the one useful value of Thompson One, is that they do give you analyst reports. But for right now, whatever reason, our portal's having trouble with not having the password in it. So they must be playing with it or something like that. All right, here's the last thing. I want to wrap up. I know it's been a long time without a break, but this is something else that's going to show up on your midterm. The other analysis that you're going to have to do, so I'm going to call this the Costco sell model. So we have a buy, a sell, go back to the buy. redo. Where was I? All right, I was at 123. And then what I'll say is I'll make this, what did we say? 85.5. 85? Let's keep it simple. 85 and grow the revenue a little faster. 120 plus 12. There we go. 138. Let's put an example of a buy, a sell, and a hold. And I'll put all of these on Canvas so you can see all three models. Right? Because again, we'll get into this next week with a different company. But let me go briefly to the last thing you need to do, which is there's a tab called CFI. And on the CFI, you don't want to delete, but between 2014 and 2024, hide. Don't delete. Because if you delete it, you'll wipe out your valuation. But you'll notice I had a total and some percentages over here on the right. This total sums up the historical 5 years. And what this allows us to do is this allows us to do a quick 5-year historical cash flow analysis based on the firm. When we do CFI, there are 4 primary sections of CFI, right? As we know from our economic conversion. The first was free cash flow, the operating cash flow. The second was enterprise value, which was driven by our CFI. Free cash flow plus non-operating cash flows equals CFI. The third was what happened to the debt holders, and the fourth is what happened to the equity holders in terms of debt and equity cash flows. So when you do a CFI analysis, you have to talk about all 4 sections. Like the ROIC tree, it's important to refer to actual data. So you got to refer to real numbers, right? So in this case, if we were to do a quick CFI analysis of Costco, historical data, which again will help us with our valuation. Gross cash flow, $12.12 billion, steadily increasing over the last 5 years from $1.9 billion to $3 billion. Gross investment, $7.5 billion, a 61.5% reinvestment rate before acquisitions. They virtually made no acquisitions, which meant all of that became free cash flow. So again, about a 38.6, call it 37% of free cash flow, which meant about 63% rounding off of reinvestment rate. Okay. What did they do with the $4.6 billion over the last 5 years? Well, they basically increased their excess cash by about $2 billion. They also spent some money on some non-operating assets, or got some money, from non-operating assets, probably sales, and ended up with about $3.5 billion of CFI. What did they do with their $3.5 billion of CFI? $2.8 billion increase in their debt. Did they need to increase their debt? No. Discretionary increase in their debt. What did they do with it? They paid out $5 billion in dividends and almost $1.9 billion of stock repurchase. Most of that dividend payment came last year as a special dividend of $3.5 billion. Okay, which was primarily funded by the debt, because most of that debt was increased last year to pay out that big dividend last year. Okay, so again, telling us what happened to the company on a cash flow basis, thinking through those 4 sections of CFI. So when we say CFI analysis, that's what we're going to be talking about. You need to go through the summary, you need to refer to specific numbers, and you should talk about some of just the general trends in each of the sections that you noticed as a result of the numbers. That's what you got to do in a CFI analysis, and this will be on the video.